All right, so today we're going to be diving into forex hedging.
Okay.
Um, this is something that's obviously super important in the world of forex, and you've shared some really fascinating materials with me
Yeah.
on how traders and businesses try to protect themselves from, just wild currency swings.
Absolutely.
And I think our mission today is really to try to give everybody a clear understanding of this risk management tool and how it actually works in practice without getting lost in, all the jargon that can sometimes surround finance.
Right. I think that's key,
Yeah.
because it can get very complicated very quickly.
Yeah, exactly.
But fundamentally, when we're talking about Forex and we're talking about hedging and managing risk, it's not about making a huge profit. It's about safeguarding against potential losses
Right.
when the currency exchange rate moves against you.
Okay, so let's start, I think, with maybe one of the most basic forms of this, which is direct hedging.
Sure.
Can you explain how that works?
Yeah, so direct hedging, the concept is very straightforward. You open two opposing positions on the same currency pair.
Okay.
So if you think the euro is going to rise against the dollar,
Oh, okay.
you buy Euro USD.
Yeah.
And simultaneously you sell Euro USD.
Okay.
So that short position acts as a safety net, essentially, if the market goes the opposite way.
Right, yeah, like a built-in safety net, just in case things don't go the way you hope.
Exactly.
Now, what about cross-hedging?
So cross-hedging involves using a different currency pair, but one that has historically moved in a similar direction
Okay,
to the currency pair you're trying to hedge.
got it.
So, for example, if you're exposed to Euro USD, you might consider using USD CHF.
Okay.
The Swiss franc and the euro, because of the close economic links between Switzerland and the Eurozone, tend to move in similar patterns.
Interesting. So you're sort of using a correlated currency as a proxy.
Exactly.
Okay, got it. Now, we also saw some discussion of using derivatives for this purpose.
Right.
Things like options and futures. How do those fit into this whole forex hedging picture?
So derivatives like options and futures contracts can be very useful for hedging.
Okay.
So, for example, if you think the euro is going to weaken against the dollar,
Okay.
you could buy a put option
Okay.
on EUR USD, and that gives you the right, but not the obligation,
Got it.
to sell euros at a certain price in the future.
Okay.
So essentially, it's like an insurance policy
Interesting.
for your euro holdings.
And futures contracts.
Futures contracts are similar, but they obligate you
Okay.
to buy or sell at a certain price on a certain date.
Got it. Okay. Now, I also saw a mention of something called using multiple currency pairs.
Yes.
Can you tell me a bit more about how that strategy works?
Yeah, so this strategy looks at currencies that tend to move in opposite directions to each other.
Okay.
So, for example, if you think that the Australian dollar will strengthen against the U.S. dollar,
Okay.
but you're worried about overall USD strength, you might go long AUD USD and short USD JPY.
Okay.
Since the Japanese yen and the Australian dollar tend to have a sort of inverse relationship, I say that helps to kind of balance out your exposure.
Okay, now what about this thing called forex hedging with CFDs? I saw that come up a couple times.
Yeah, so CFDs stands for Contracts for Difference.
Okay.
And they're essentially a way to speculate on the price movements of currencies
Okay.
without actually owning the underlying currency.
Okay.
So, for example, if you have a long position in a certain currency pair,
Okay.
but you think it might weaken in the short term,
Yeah.
you could open a CFD position
Okay.
in the opposite direction as a hedge.
Interesting. So it's kind of a way to manage short-term fluctuations without actually having to unwind your original position.
Exactly.
Got it. Okay. I'd love to maybe bring this to life with a concrete example.
Sure.
So let's imagine a U.S. company
Okay.
that's expecting to receive a payment of 1 million euros
Right.
in 3 months' time,
Yeah.
but they're worried about the euro weakening against the dollar.
Sure.
During that time, what are some hedging options that they might consider based on what we've talked about?
So there are a couple of main options.
Okay.
One is that they could enter into a forward contract,
Okay.
which would allow them to lock in the exchange rate
Okay.
for that future date, so they know exactly how many dollars they will receive.
Got it.
The other option would be to buy put options
Okay.
on EUR USD, which would give them the right to sell those euros at a predetermined exchange rate
Okay.
if the market moves against them.
Okay, I see. So they have a couple of different tools in their toolbox to manage this risk.
Exactly.
So let's talk about the advantages of forex hedging. What are the main benefits that businesses and investors are trying to get out of this?
Well, the primary advantage is that it reduces risk.
Okay.
It helps to create a more predictable cash flow.
Okay.
For businesses and investors, it allows them to plan better.
Yeah. Makes sense.
And then you also have the flexibility that we talked about.
Okay.
There's all these different strategies and methods.
Yeah.
So you can really kind of tailor your hedging strategy to your particular needs and circumstances.
Okay. But I imagine there must be some disadvantages to this too, right?
Absolutely.
Yeah.
So hedging does come at a cost.
Okay.
There are fees involved.
Got it.
There are premiums if you're using options.
Yeah.
You have to pay the spread, which is the difference between the buying and selling price
Right.
of the currencies.
Okay.
And then it also adds complexity.
Sure.
Hedging is not something that you can just jump into without really understanding what you're doing.
Yeah.
And then, importantly, while hedging can protect against losses, it can also limit potential profits.
Right. Yeah, that makes sense. So you're essentially capping your gains and your losses.
Exactly.
So who is it that's typically using these kinds of hedging strategies?
Well, you'll see it used by businesses that are involved in international trade,
Makes sense.
investors with global portfolios,
Okay.
and, of course, forex traders themselves,
Okay.
especially in volatile markets.
Yeah.
When currency exchange rates are fluctuating a lot, hedging becomes particularly important.
Right.
Okay, so to kind of wrap up this deep dive, it sounds like forex hedging is this really interesting set of methods to protect against the risks of currency price movements.
Exactly.
And we've covered, a bunch of different ways to do it, from directly offsetting trades to these more complicated things like options and futures and CFDs.
Right. The key thing is to understand that it's about risk management
Yeah.
more than it is about, making a quick buck.
Right. And I think this is something that might actually be helpful for people to think about even outside of finance.
Yeah.
Like this idea of taking a counterbalancing action
Sure.
to reduce uncertainty
Absolutely.
might apply in lots of different areas of life.
That's a very valuable point to consider.
Yeah. Well, thanks for joining me on this deep dive into forex hedging.
It's been a pleasure.
Until next time.
Take care.
Bye.